they're coming from. I always enjoy kind of seeing the reach that we have, and I'll try to keep up as fast as I can with the response as soon as I get up. So tell me where you guys are dialing in from as soon as I find my chat window here. Okay, here we go. All right. North Carolina, Montreal, Vermont, Columbus, Michigan, Maryland, Uganda, Vegas, New York, New Jersey, Switzerland, Arizona. Have I been to Tucson? No, Ken. I've been into Phoenix and Scottsdale quite a bit. New Zealand, Sydney, that must be Jackie. We've got Dallas. Okay, screen is too small. Yep, no, I'm going to blow that up. Don't worry. Watch this. Boom. How's that? So we're going to share number 5. We've got charts loaded up. PowerPoint. We're going to try to keep PowerPoint to a minimum because nobody really likes PowerPoint. We've got recording going and we're in business. Okay. So from there, guys, tell me who right now is trading options. Anything besides anything above, like you bought a couple call options or a couple put options, and who has been who's trading options more than just buying a few puts and calls. So if you're trading options, type in yes. If you are new, please type in no, so I know how to gauge this presentation. All right, that's a pretty even split. So guys, you're both sides are going to have to kind of bear with me a little bit. This is an intro webinar. As you guys know, I've traded options for a long time, but the business has just launched our option products. So a lot of clients that I've worked with over the years are joining or just getting into options for the first time and are about to learn the strategies. So those of you who understand options, bear with us. This is an intro webinar, so I promise there will be some takeaways for you. But this is new for a lot of the clients that we're working with. So we're going to start basic, but I can promise you on the other side, you advanced option traders, you will learn something. And those of you who are new, you will be also confused today. So don't worry on both ends. This is just simply to show you some of the benefits of trading options, talk about the style that we use, how it ties in so well with our style of analysis. So there will be much more to come in terms of clear-cut education as we kind of segment all you guys out depending on what your experience is. So just bear with us. So with that being said, let's dive in. Okay. Um, so what's on tap for tonight? I just kind of went through the itinerary, but the most important thing that I think we want to focus on right here is the high probability income. That's really what we want to focus on, is how to set up high probability trades that can generate income immediately. That's what we're here to do, and that's what ties in so well with options, and then specifically our style of tech analysis. Okay, we are going to show you that, in fact, technical analysis and charts are important. You can't hide from market direction when trading options. I believe that you still need to rely on your good old-fashioned technical analysis in order to effectively trade options. Else, you can get yourself in a bit of trouble. You can also wind up trading too often when you don't use charts. A lot of people trade options without any acknowledgement of charts, market direction, don't have a bias, and I think your commission dollars go very high, and you can get yourself into trouble. Okay, so we are going to take an approach of technical analysis, and specifically advanced technical analysis, in order to keep commission dollars down and keep ourselves out of trouble. And then finally, I've kind of jumped ahead here on the technical analysis side. But most important, one of the concepts I really want to focus on is the time decay aspect, and tying that into our advanced technical analysis techniques, and show you how to take advantage of those. Okay, so from there, what are we here to do? Okay, our goal is aggressive account growth. Okay, that's what we're trying to do. That's the whole purpose of trading with options is aggressive account growth. Let me get my screen drawing here. Okay, you want to learn to harness the leverage that options offer while defining and minimizing risk. Okay, we're going to talk about the difference between income trades and wealth building trades, or aggressively, kind of more of aggressive trades. As I keep harping on, we're going to use advanced technical analysis to identify the best markets to deploy our option strategies. So we have a lot to do in a short period of time. So a little bit of basics of options, okay? And this is extremely interesting. And those of you who may have bought a put or call before, have you ever bought a put and the stock, here's your chart. The stock does this. You buy your call right here, and the chart does this, and it goes from 60 to 65, and you're like, yay, I have a winning trade because I bought it 60, 65, but then you look at your option and you've lost money. Okay, that's a killer. And that is one of the reasons that a lot of people get very discouraged with options up front, is because it's so easy to come in and just buy a call and say, I'm going to spend X and hopefully I can make 10X. But there's a reason that this trade did not work out. And the reason that this trade did not work out is really what we're here to focus on and show you how to take advantage of. Basically, I don't want you to be the guy who buys a stock at 60, it goes to 65, but yet you lost money on the options trade because you're long a put or call. There's a reason for that. Okay, and here is a very alarming statistic. Over 75, and I know it's over, 75% of options expire worthless. So that means if you've bought or put or call, you have immediately, I would say, less than or equal to a 25% chance of making money. Okay, if you get into a trade with a less than or equal to chance of 25%, I mean, that's a problem. The reason is the market makers have, by design, and the way options are priced, they are in here picking your pocket as you are holding long puts and calls. And we're going to show you that a vast majority of the options traded right now are, in fact, long options, which give you the ability, give the market maker ability to, in fact, pick your pocket.
G'day, Todd. G'day, everybody. I just wanted to
Yep,
rudely butt
I
in
just
and
got the
just let you know.
message. Thank you very
Okay,
much.
that's me.
That's the last option. Thank you very much, guys. So this part right here, thank you, Jackie. That was the professor from Sydney who runs our overnight desk. But this is the important part. 75% of options expire worthless, and that is by design. Okay, market makers are able to basically take money from your account in terms of the time decay with holding long puts and calls. All right. So there are times when the market makers are not able to control the market so well. All right. And those are periods of high volatility. All right. And we can then use that time to exploit a mathematical edge. All right. When markets are volatile, they don't have the ability to pick your pocket quite as well if you use the same strategies. And in fact, you can beat them at their own game. Now, the mathematical edge that we'll use, that for now we'll just call volatility, VOL for short, okay, that is basically what the market makers are doing. Our edge over the market makers can be increased when you're using the advanced tools of technical analysis. So we're going to show you how to not buy a call at 60, have the stock go to 65, and have you lose money. We're going to show you how to take advantage of that and kind of flip the script. Sorry about that, guys. I'll get the chat window over there so I can see all your questions. So a little bit about me. I run tradinganalysis.com. Most of you probably have come across the website before. I've been on CNBC quite a bit. I was a regular on the show Money in Motion, been doing guest appearances for 4 or 5 years. So, a little bit about me. Married. I live in New Jersey in my trading office. Met my wife grocery shopping, believe it or not, on a Monday night. It was in December. And we went back to kind of recreate those photos. That was kind of funny. So yeah, I was the stalker in the um, in the grocery store, and she kind of was looking at me a little bit. So it wasn't like complete pickup line. I used no line. We got married 2 years later, and lucky enough to have the Trumpster at the wedding. We got married at Trump National, and my buddy's always joking me that saying, "Todd, you're fired" in my wedding picture. Um, just about what I'd say 8, 9 months ago, we got this picture, a little double head and shoulders breakout. These little guys are now in our lives, and they're sleeping. So we have twin babies, and that's our updated. So that's a little bit about me. I've got background in the markets really since even before college. I was trading options in my dorm room in college, not really going to college and not going to class. I remember our economics professor. I think he was financial economics 301 at St. Lawrence. I hardly went to class. Trading AOL call options in my dorm room. This was in '99. Would have been a sophomore. And I was basically just showing what I was doing. I never went to class, and he just gave me a 3.5, and he's like, "All right, just get out of here," because I was just talking the stock market. Because that was '99, obviously when things were going ballistic. So it's pretty funny. All right, so options basics, understanding pricing basics. We're going to talk about two concepts: extrinsic and intrinsic value. Here's an important part, okay? And again, those of you who understand options, I know it's review. Those of you who are new to options, buckle in. Before we do, here's a pretty alarming statistic, and this was done in, speaking of '99, by the CME, Chicago Merc. This is total CME exercised and expired worthless calls and puts. This was on, I think, 5 futures markets. So 5 of them, stock indexes, bonds, commodities. These are all the major indexes that products are traded at the Merc. And they did a study here in like 2002, how many options were exercised versus how many were expired worthless. In 97, 2 million were exercised versus 6.7 worthless. 2.2 exercised, almost 7 worthless. 1.8, 6.2. So 6 as a percent of 20, okay? I mean, that's about a third, right? Actually a little bit more than that. And that's the overall CME, right? No, it's actually 3/4, 76%, a little bit more than that. So 25% of the options that were bought were never exercised. Now, here's something that's even more alarming in the NASDAQ. And remember, this is in the bull market go-go days when things are just going crazy. Puts, percent of exercised puts, 6%, 3%, 1%. Okay, that's downside protection, which you say, okay, that makes sense. If the Nasdaq's going crazy, people are buying protected puts. I don't expect a lot to be exercised. Okay, but then, okay, on the flip side, look at the percent of exercise calls: 97, 9%, 98, 26, and 99, 16% for average of 17. So even in the biggest bull market that this country's ever seen, only 17% of long call options were ever exercised, and 82% expired worthless. So, I mean, even in the greatest bull market, you weren't seeing a lot of people making a ton of money by being long options in the greatest bull market of all time. So my point here, guys, is being long options is a sucker's game, and you will lose money doing that. Okay. Now, so here's the breakdown of option pricing. Okay. Google. This is the July 14, 570 calls. And Professor, if you want to jump in here, Professor does our Sydney desk. If you want to jump in, and if you have anything that you would like me to slow down on, anything you'd like me to clarify, please do so, because I would love your feedback. And if I need to slow down on anything, just throw a net over me, okay?
I'll certainly let you know, and I'll leave the question for Trish later as to when she was reading the back of the cheese packet, why she ended up picking you over the cheese. Obviously, there was something in that grocery store about you that attracted you.
And the funny thing, my best man at my wedding during the speech, he's like, I'm sure glad Trish didn't look at the 12 pack of Miller Lite and the Playboys that were in your shopping cart. Oh my God, that's funny. I was shopping for dinner that night. All right, anyways, guys, so let's go. That's funny, Jackie. So, so Google. Okay, so here's a price of Google. Shares trading at 579. And if you're going to buy 100 shares of a $579 stock, I mean, do you guys have an extra $57,900 laying around to buy 100 shares of Google? No. Maybe. Hope you do. Not a lot of people do. So at the same time, the 570 calls, which were only about $9 below the market price, 570, 579, we're trading for $19.25. Okay, so what does that mean? This is basic. One contract, options are trading contracts, represents 100 shares. So you take that $19.25 that cost to buy one contract, which represents 100 shares, you multiply it by your 100 shares, and it costs you $1,925 to get a hold of 100 shares of Google. So it costs you $1,900 versus $58,000. So, I mean, obviously that's a nice benefit of buying options. That's why so many people come in and say, ooh, I can get $2,000. I can get $58,000 worth of stock for just $2,000. So, I mean, it's pretty enticing. But again, that's why so many options expire worthless, because it's set up that way and the market makers will set you up. But we're going to show you how to trade on the side of the market makers and make money along with them using our style of technical analysis, which I think enhances our edge over the marketplace. So before we jump into that, let's break down the $19.25. How does that break down? How does an option price, how is an option calculated? There's two parts. There's intrinsic and there's extrinsic value. All right. At the time, the 570 calls, which we priced out over here, $19.25, had $8.40 of intrinsic and $10.85 of extrinsic. If you add those two up, it will equal 1925. Now we're going to break this down and show you what the difference is between intrinsic and extrinsic value. The point of tonight is really we're going to be focusing on this part, which is the extrinsic value of an option. Okay, so let's jump right in here and let's look at a live platform. All right, now I'm going to explain what this means with a live setup here. Hope you don't mind. This is Tesla from today. This is my live account. And Tesla was trading at $219.58. That was, actually, I might have caught that at the close. I don't know. $219.58. All right. You look over here, and here's what you call the option chain. The left side is all calls, and the right side is all puts. If you look at the pricing of options, it gives you a bid and ask, just like any market, trade in FX or commodities or stocks. The bid is where you sell. This is the MM's, market makers bid, market makers ask. If you wanted to sell an option, you'd have to hit, this is the trader lingo, hit a bid equals, if you want to sound like a trader, hit a bid equals sell, or take an offer equals buy. Ask is offer over here. So if you want to sell an option, you got to sell it at 32.70. If you want to buy it, you do it at 33.90. Or you could stick an order in somewhere in between the spread. That's cool too. So let's look at let's look at options that are very much near the market. So we're trading at 219.58. Let's look at the 215s, the August 215s. Again, we have puts over here and calls over here. The 215s give you the right to buy Google if it goes above, if you hold the option above 215. We're $4.58 above. Okay, so what you're going to see is over here in the intrinsic value column, you have $4.20 of intrinsic value. That is basically the price minus the strike. That is how much the option is ITM, in the money. That's how much real value the option has. Notice as you go down to the 220s, we are, what, 62 cents below the 220 strike. So this thing has no intrinsic value. It has all extrinsic value. So intrinsic is very easy to know. It's how much money the option is, how far the option's in the money. Okay, that's real value. Extrinsic value is something that's a little bit more esoteric and a little bit more difficult to understand, but with time, this is what you really want to focus on as an options trader, is the extrinsic value. Extrinsic value is a combination of how much time is left in the option and volatility. Okay, those two make up EXT, extrinsic. Now, this is the August option, and this parentheses right here in Thinkorswim means it has 31 days to go. So part of the extrinsic value is time left in the option, but the other part is volatility, and we're going to focus on that quite a bit. All right. So here is looking at it another way. If you are looking at an at-the-money call, so Tesla's 215, we'll look at a 215 call. This is how a call option breaks down. As soon as, let's say, Tesla, TSLA is 215, and we're looking at a 215 call right here. Let's say that is the 215 call. As soon as we go 216, 217, and so on, you start to get intrinsic value. Remember, intrinsic value is how much it's in the money. Extrinsic value is time and volatility. All right. The maximum amount of extrinsic value having an option is when it's at the money. But then as the market, as the call goes further and further in the money, you can see the amount of extrinsic value decreases as a percent of the overall value of the option. Up here, it's a very small amount of extrinsic value and a lot of intrinsic value because it's way in the money. Okay, so that's how a call is basically priced. And then you could do the same thing for a put. It's just going to look a little bit different. All right. So the only thing you need to take away from there is the intrinsic value of a stock, extrinsic value. Now, we like trading stocks with this particular strategy. They have a great characteristic that the other markets that we do like to trade don't possess. Okay, they can change. The short-term outlook for a company can change in a dime. News, announcements, whatever it may be, can change very quickly. So that has the ability to really mess with the extrinsic value of an option. So that creates trading opportunities. This is really where we want to focus when we're trading with options in individual equities. We want to focus on the extrinsic value side. Okay. When you have a special extrinsic value situation within the context of a solid technical analysis setup, you have an even bigger edge over your fellow traders and the market makers. Okay. Now, the last thing we're going to focus on is our preferred style of technical analysis in individual equities. Okay. It actually excels in individual equities. We are big followers and traders of the Elliott Wave principle. Okay. All Elliott Wave is basically a human's report card. Human progress's report card. The better humans are doing on a mass scale, the better our stock prices do. Okay, that's not really the same for FX. It's not really the same for bonds. Commodities have much different trading characteristics, but stocks are really the pure representation of how humans are doing. And the Elliott Wave principle is really just a barometer of how traders are interacting on a mass basis. It's determining when Traders are not very emotionally attached to a trend and they're underparticipated and when it's time to get involved in that trade. Elliott Wave is very good at showing you when a trade is way oversubscribed, it's crowded. The psychology has completely just pushed everyone into the market based on news or whatever it may be. It tells you when a trend is overcooked. And stocks, again, show the best Elliott Wave patterns. So trading options with Elliott Wave is really where you're going to see your big edge. All right. The other market we like to trade is ETFs. All right, exchange traded funds are great. And the way we kind of look at this is you could trade like a hedge fund, like a macro hedge fund. So macro hedge funds like to trade the major 4 asset classes: stocks, commodities, currencies, and fixed income through ETFs. They tend to have low volatility components, so they're not the best candidates to be really focusing on these extrinsic value strategies. There are times to buy options, okay, as I warned you against. I generally don't do it in individual equities, but I do like to do it in ETFs, okay, because they don't have big whipsaw price action from sudden news announcements and really high high extrinsic values, okay. When a big news announcement comes out with a stock, let's say the option price is, let's say it's a $15 option, you've got 5 in intrinsic, 10 in extrinsic, EXT, to give you the $15 option. Let's say something came out, all right, and the stock shoots up to $20. So the stock moves up $5. Now, okay, if we had $5 of intrinsic, it's obviously the strike is going to be a little bit $5 below where we were. So now we're going to have $10 of intrinsic, INT, but you're going to see this one, this went from 5 to 10. You're going to see this one go way up. 10 might go to 30. So now you could have a very expensive option that's now priced at 40. Okay, because you have a jump from 10 extrinsic to 20 extrinsic because of the big news announcement. News brings in volatility. Volatility makes options more expensive. So you went from a $15 option to a $40 option with only a $5 move in the underlying, and that's because of news, earnings, and we're right in the middle of earnings season right now, and we've just kicked off earnings season. So the volatility component is very expensive. Put most simply, guys, as the volatility of a stock goes up, you're going to see those options are expensive with high VOL, not volume, but volatility. All right. Volatility comes as a result of news, earnings, etc. So you really want to pay attention to how expensive an option is. You're not going to see a lot of fluctuation from the intrinsic side. You're going to see from the extrinsic side. Okay. So here's a Google options chain right here. And this I find is another interesting part about why people just insist on buying options, especially in individual names. So we have Google, this was on July 8th, and we have 67% of the calls, okay, calls are over here, of a delta less than 40. You can replace delta with a percent chance of success. So we're looking at 0 to 20% chance of success, 21 to 40%, 41 to 60, 60 to 80, 80 to 100. Delta is essentially the same thing as the percent of this percent chance this option goes in the money. Options have it priced out, and the way options are priced is based on your probability of you being able to make money by going in the money on this trade. So this one, you would see a delta, which again is percent chance of success, 0 to 20, 21 to 40. You saw 67% of the options traded that day were the delta of less than 40, which means less than a 40% chance of success. 2/3 of the options traded that day in Google have a 67% chance of not making money. That's crazy. On the put side over here, same thing. 63%, 36 plus 27 is 63%. Were traded at a percent chance or a delta of 0 to 40. So, I mean, that's why I think options trading is scary for people who don't know what they're doing in the beginning, because if you're just buying options, you have the chances of making money stacked way in your favor. Okay, those chances you can flip and put in your favor by trading the right strategies, learning how to buy and sell options, and putting it within the context of your style of technical analysis. Okay, Christian, we're definitely going to get into that. And that is the million-dollar question. Why is high extrinsic an edge? And that question was very well timed. Okay, so we're going to bring in this concept of time decay. Remember, intrinsic is simple. I'll just put it over here. INT, I think you guys got it. EXT is the other one, extrinsic. There's two components. There's time and there's volatility. Time is a big time depreciating asset, especially in options. Okay, as you're holding an option, as you get closer and closer to expiration, you're like this poor guy. It's just melting away below your feet. Okay, eventually you're going to take a dive. Now, it's a bad picture because polar bears have no problem swimming in cold water, but I couldn't really find an image of some poor animal stuck on ice who's about to go in. But I thought it was a cute picture anyways. So as time melts away, if you are long options, you are this polar bear and you're going for a cold swim. All right. If let's say, let's keep going. I'm not going to belabor that point. Okay. Because we have this nice graph right here. I'm going to show you how to take advantage of this time decay by trading options, and that's what we're here to do today. Here is a call option, ATM at the money. Down here is timed expiration in months, so 9 months, 630. This is percent of premium, and you can substitute premium for EXT, extrinsic. All right, this is only the extrinsic side of the option. From 9 months to 6 months, okay, and this is the expiration. All right, so from 9 months out to 6 months, you are going to lose 10% of the value of your option. From 6 months to 3 months, you're going to go from 90% to 60%. You're going to lose 30% of your option value. Then in the last 3 months, you're going to go from 60 to 0. You're going to lose 60% of your original option value. So you can see this is an accelerating time scale. This is in the past, those of you who've bought puts and calls, your options, unless the stock just went ripping up to your objective, if it just kind of chopped around or worse, it went down. In the middle, just kind of chopped sideways, or went up moderately, sometimes the pace of this option decay or this time decay does not make up for the small price gain that you've seen in the option. In order to make money buying options, you need to see the stock do that straight up, because the extrinsic value as you get closer to expiration is going to really chew away at the value of your option. We are going to trade such that we can take advantage of this sharp decline in value of the options and take that money and put it in your pocket. Okay. So Google, let's look at implied volatility of Google. And it actually is pretty timely because we have earnings coming up in Google right now. Notice Google on the daily, implied vol is right here. Big spike into a massive gap up in earnings. We had another high implied volatility spike here. High implied volatility in earnings didn't really do anything. And now we have another situation where Google is moving up. And as we get closer to the date, which I think is the 17th for Google earnings, you're going to see implied vol move up again. Okay. It's what you want to be doing is focusing on opportunities when the implied volatility is towards the top end of the range up here. Okay, this is when we can deploy the strategies we're going to be talking about and put some ridiculously high probability trades in your favor. Okay, now this is some crazy math. I hear you, but let me just preface this and say I'm going to show you how to put trades together that can give you greater than an 86% chance of success. And in fact, most of the trades we put on that I put on with our clients have at least a 68% chance of success, sometimes an 86% chance, and sometimes it's 95% chance of success. And this is this concept of standard deviation. This is the extrinsic value. This is how they begin pricing options. This is the bell curve that you guys remember. I'm going to touch on this briefly and not get too wound up. This is the standard deviation curve, okay? What this means is if you add those two numbers together, it's 68.2%. 68.2% of the time, an option or a stock price is going to fall between 1 minus 1 SD, standard deviation, and plus 1 SD. So you're going to add this side plus this side to get 68. If you add the 68 plus these two guys, 13 and 13, okay, that is a much higher, okay, much higher. You're going to be upwards about 95% that it's going to fall between minus 2 standard deviations and plus 2 standard deviations. You can put on trades that will make money as long as the stock stays between minus 2 standard deviations and plus 2 standard deviations, which is 95% of the time. I mean, that's massive in terms of being able to be correct on the trade. And as I said, when you overlay with your chart analysis, you can increase the chance of success. All right, let's take a look at this in real terms. This is Doe. This is a great trading platform. Thinkorswim, Sosnoff put out. Love it. Trading on it. Going to introduce it to our clients. Okay, so this is Google today. 594 was the last price. We are looking at possibly shorting a put. Okay, if you short a put, okay, let's think about that. If you want to be long a put, you want the stock to go down, so you are bearish. If you short a put, that must be the opposite, so that must be bullish. So you want the stock to go up. This is a nice platform in that it lays out exactly what the standard deviation is for this particular instrument. We're looking at Google. We're looking at an option that is going to expire in 31 days. Okay, so this is the August monthly, Aug monthly. 31 days, it's trading, I just wrote over it, $4.20. Okay, this dotted line right here is the one standard deviation. It says it right there, one standard deviation, 68% chance of success. Okay, here's that bell curve we're looking at. Basically what it's done is taken this option pricing and showed you that, okay, right at the $550 level, that's where the one standard deviation is. And remember, we have all, as long as Google is anywhere above this price, you will make money. And it prices it out that you have an 86% chance of making money on that trade. Okay, that means basically if Google just stays a little bit above 550, you're going to collect the entire amount. You've shorted an option, meaning you would have sold 420s. You would have received $4.20 per contract in your account. That's your money to keep. All right. And then if you go over to, let's just take a look at Google on a chart. And I'm just going to dive in quickly here on what the 420 Google would look like. Or sorry, that's no 420. I'll get back to my option slide here. 520. Okay, here's an hourly chart of Google with 31 days to go. We're looking at selling the 550 put. All right, that's way down here at 550 below this low. Okay, so we have a long ways to go over the next 30 days for Google to fall below this level. Those of you who are traders with us and the Elliott Wave theory would know we would expect this to be support, being that it's the prior fourth. So we have a long ways to go on the downside over the next 30 days. And of course, we do have earnings coming up. So volatility is going to be a little priced a little high. But this is just the very beginning of understanding how to take advantage of high probability trades. This chart right now, Google does have a high probability, or does have a high implied volatility. Let me just bring up the real chart here. So just go charts and we'll go to Google and just show you that, okay, the implied volatility is kind of in the middle of its recent range. So implied volatility is on the rise because we do have earnings coming up. And notice what happens after earnings. The volatility comes out. And this is the time, and this is where you want to look to take advantage on this, what they call volatility decline. This is where the money is made. Okay. What happens is option prices are really pumped up ahead of earnings and ahead of big announcements and different events, then the volatility comes out. If you know how to position correctly, you can make money on this volatility decline that happens all the time. Okay, let me just scroll back. And look, you have all of these volatility spikes, decreases, spikes, decrease, spike, decrease. This is where you want to really focus on making money, is on the volatility decline. And of course, you do it within the context of what the chart is doing. That's going to put you in a good position to make money. All right. So, looking pretty good there on volatility. Six Sigma. Wow, Edward Dunlap. Really? Six Sigma. Wow, we're only going to go 1 and 2 standard deviations, not 6. That's like a guaranteed winner. That means if we were to do a karate match, if you're a 6 Sigma black belt, it's certainty that I would lose. So you definitely want to sell my option. Okay. So the premium aspect is this: by selling selling this value right here. Okay. If you were to buy a call, if you were to buy, let's say, the at the money Google 594, you're what we call long premium. You're long the stock, and you need the stock to really move up to take advantage of the move up. You really need the stock to move up quickly to get rid of this falling implied volatility, right? If somebody tried to buy the pullback here in Google right after earnings, okay, and they bought it here, the stock here, okay, let's say at 557. Let's say they bought the stock at 557. It goes against them. They say, uh-oh, well, I had to stop at 500, so no problem. Then it comes back up to 557, gets back up to 560. The volatility is much lower here than where it was over here. So even though they're back to break even or slightly in the money where they purchased the stock, the call option is going to be negative, and you're not going to make money on that. You're going to get hosed. All right. So that's what we call long premium by being long an option, and by selling an option, that's what you call short premium. Now, there are risks with being outright short options, and we're going to show you how to contain those. So the question is, do you want to be selling premium or buying premium? There are very specific times in the market when you want to be long premium, and very specific times you want to be short premium. The two factors that come in are the implied volatility level and the Elliott Wave position. That is going to help you decide whether you want to be long premium or short premium. Said differently, and again, don't be scared by these fancy terminologies. Long premium, you could just substitute that out and say long options and short options. Periods of high vol, you want to be short options. Periods of low vol, you want to be long options, but with a caveat that I'll explain here in a second. Remember, the higher the volatility, and all volatility is, guys, is how much. Okay, here's an example of vol. Let's say the projected trend for a stock is this. All right, it's going to go up. But the volatility, let's say it's a very quiet defensive name, not a lot of volatility, it generally takes this price, or generally takes this shape. It doesn't deviate much from its central mean. That's going to be a low vol instrument. Something else like a NASDAQ stock like Google or Tesla is going to do something with high vol. It's going to look like this. Bam, 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 all over the place. That's high vol. This is low vol. These options are going to be expensive because of the high volatility. If you think about it, why would those be more expensive? We're playing a game where there's ultimately a strike. All right, let's say the stock is at 550 and you want to get to the 570 strike. With an instrument that trades like this, there's a lower chance that you're going to tag the 570 strike. With an instrument that trades like this, up and down and up and down, much better chance that you're going to get to your 570 objective. So if you have a higher chance of that option going in the money, okay, because of the volatility, they're going to make you pay for it, right? So there's times that we need to understand when to want to be long this volatility and short this vol, or long the premium or short the premium. Okay. So first strategy we're going to talk about is debit spreads. All right. The way to get long options is with debit spreads. The way we can get around this time factor, this volatility factor, is, let's say we want 2, 3, okay, let's say 1, 2, and let's say our wave 3 objective is here at, let's say, $80. So we're starting at 65, and let's say we get in the trade here at 70. Okay, if we think we're heading up here to wave 3 at 80, you could just buy the 70 calls, but then, as I've described at length, you need the stock to just go straight to 80 to make money, and do it in a big fast manner. Okay. Another way to do this is with a debit spread, and this is where we're going to start trading directionally. This is a directional option play. We're going to buy the option, but you're also going to sell an option at the same time. Okay, so if you have a $70 call, $80 objective in wave 3 based on, let's say, your fib and wave, which we'll talk about, this is your reason for being in the trade. You want to go from 70 to 80. Okay, they say bulls make money, bears make money, and pigs, you know what happens. Slaughtered. So what I'm saying here is, don't be greedy. Okay, use your objective technical analysis style that says, I see the market going from 70 to 80. So the way you do that is you buy 70 calls, and then you define your objective at the 80. So what you do then is you sell the 80 calls in the same month. Let's say this is August. So this creates a debit spread. You're going to buy the 70 calls and simultaneously sell the 80 calls. What that does, it gives you a max gain difference between the strikes. So if we've bought 70s, sold 80s, you stand to make $10. Okay. Now, debit spreads are great for trading strong breakout moves. Okay. And what's even better is you're minimizing the time decay. Let's say I'm going to go back. That example is getting a little crazy. Let's say we did it 1, 2, 3. Here's our 70. Here's our 80. Let's say, and that's our price, and this is the expiration. So let's say this is August 19th, which will be your expiration, third Friday right here. Okay, so let's say that's your objective. Okay, so let's say the stock does this. 70, we go back, we break down a little bit, and then we go up, and then we break down, and then we don't quite get to our 80 objective, yet the stock still went up. If you had only bought the 70 call, you might have lost money on that. Why? Well, you know the INT, the intrinsic value, is going up, but the EXT, the extrinsic value, is going down. The way you can minimize that and offset this is by selling the 80 call. If you short the 80 call, okay, the money that you would have otherwise lost by being long a call, you are now making that money. Okay, there's a little piece of the option that comes off every single day. Okay, so if you sold the 80 calls, somebody else has bought them. Okay, so you are making a little bit of money plus, a couple dollars a day on the 80 call, but that is offsetting the money that you're losing in the $70 call. So if the stock just chops and doesn't quite get your objective, you would have lost extrinsic value here, but you would have gained extrinsic value here. So you can still make money on the trade and be happy. All right. So that is the debit spread, and that's the most basic option spread that we'll put on. Okay. So you're going to buy an at the money or in the money call for X, and you're going to sell an out of the money call for less than X. Okay, which is going to be a net debit. All right, so let's say again you had to pay $5 for in the money. Remember, in the money is going to have intrinsic and extrinsic value, so it's going to be a more expensive option. You're going to have to pay $10. Okay, so for a $10 option, that's going to cost you $1,000. But you're going to sell an out of the money call based on your objective using your technical analysis. So if you sell an out of the money call, you're obviously not going to get that much for it because it has no intrinsic value. It's far away from the market. So let's say you only get maybe $3 for it. You're going to receive $3. So it's going to be minus 1,000 plus 300. Okay, for a total cost of $700 to put that trade on. But again, if the stock just kind of chops higher, this one will be losing time value, but this one will be making it. It'll make up for it. So that's the debit spread. Okay, that's on calls. Puts the same thing. Let's say the stock is going down. You think it's heading down here to the target. Stock is trading at 70. You buy a put. You need it to go straight down if you're not going to protect yourself. Okay, but if you get to your target, which is 60, you can buy the put for $10, sell this put, okay, which means you're going to receive $5. So you paid 10, received 5, it's going to cost you $5. Now, that is the max you can lose on this trade. It's defined risk. $5 is $500 a contract. That's it. You can't lose any more money than that. But you also can't make any more than this difference. So you're essentially risking $5 to make $10. Okay, you have to take out the cost of the option contract, like a commission and the price you paid. But this is a defined range that you're or defined kind of boundary that you're trading. You want to go from 70 to 60, which those of us at trading analysis, we do that all day long in terms of defining where we want to be in the trade. We don't look to put on home runs all the time. Okay, that's not how you make money trading. You trade for singles and doubles, and occasionally you get the home run. But this is a great way to trade, and this is how you start off by buying options. You buy at the money or in the money, and you sell out of the money. Now, obviously with puts, if a stock is lower, or if the strike is lower, you're not going to get as much because it's further away. Okay, the further a stock goes down, the more expensive those puts are going to be as you get deeper and deeper in the money. All right, so that's the spread. All right, so now let's take a look at some live charts. Yes, this is being recorded. Yep, Derek. Yep, this will be this is being recorded. All right, so let's take a look at a couple examples of what could be a long spread in I think Facebook is one I wanted to look at. We actually have this position on now. Okay, we are long Facebook with clients. Now, here's a very simple setup with Facebook. We haven't talked about Elliott Wave yet, but at the basis, this isn't a webinar about Elliott, but let me just tell you that the most basic function of Elliott is we look for 5-wave trends. All good, healthy trends have 5 waves. They've got 3 trend waves, and they have 2 corrective waves. So we're looking at wave 1, 2, 3, 4, and it held wave 4. By the way, Facebook held perfectly today. This was a level that we gave to our clients. We're long. We have a different option spread on. I said, guys, don't bail, hang, because this should be a wave 4 low. And it looks like we have another push up to go in wave 5. All right, so let me just do the analysis real quick, ratio analysis, and the software is built in, so you just go right to the green level. That's it. Show ratio price objective is 69.98. Okay. So the way you do this is you say, okay, Facebook is trading at $67 right now. The objective in wave 5, we're not looking for anything greater than that. We're not pigs. Is 69.98, so we'll just round to 70. So now we have a $3 expected move in Facebook. Okay, so let's go to the options side and say, all right, let's see how long, or let's see if we could price this option. So we go over to our platform. We go to Facebook. And we're not going to talk about expiration selection now. We do have a position right there in Facebook. So let's go to, what did I say, 67.70. Yep, 67.70. So we're going to look to do this in August. Will give us 30 days. That's enough time. Okay, the calls are over here. And you say, all right, well, we don't have a 67 exactly. We got a 67.5. Calls over here. So you left click over here. No, I don't want to do that. Get down, get down, get down, position down. There we go. Right click, buy, and you want to go vertical. All right. So it actually pre-populated that for us, which is great. So we have the 67.5 call. We're going to buy 10. And we have the 70 call that we're going to sell. It's calculated exactly how much this should cost, $1.04. All right, great. So then if we go over here and go confirm and send, it lays out your max loss and max profit. Your max profit would be $1,400.60. Your max loss is $1,000.40. Okay, so not a bad risk reward. And we can calculate the probabilities. And let me actually bring up another platform and actually show you exactly what the probability of success is. With verticals like this, with debits, okay, we're going to have to pay. You're not going to get the really high risk rewards. Once you start going to the next option setup, which I'll talk to you about, which is credits, that's when you can start trading with 70, 80, 90% chance of success. Okay. So that's how we would set up a very basic debit spread with Facebook. Okay. Puts, same thing. You want to buy an at the money put, at the money, slightly in the money, and then sell your downside objective. Okay, for net debit. Tesla, I really want to get bearish Tesla. I just think it's about to get wrecked. And here's the setup. Tesla moving lower. I actually almost put the trade on today. I think this is a 5-wave move down followed by a 3-wave move up. Anytime you see 5s down, 3s up, that just simply means the trend is down. Very basic. Okay, so this has a long ways to go to the downside if I'm right. Okay, I don't know. I'm not going to be a pig. I'm just going to say, okay, I am going to look for a move down to this old support level in Tesla. B wave low from June 11th is 199. We're trading 219. Okay, so a good way to do this is if we think the market's going to go lower, we could buy an at the money put, which is right on 219, and then sell your downside objective, okay, by selling a put. So again, let me just go over here and let me just see if I can load it in this different platform. I'll just load this one up, but let me go over to Tesla, TSLA, oops, TSLA, if I could just type it in correctly. So we're going to do something like 220. I mean, this would be kind of a wide one, 220 down to like 200. We'll do it in August as well. And remember, this is the put side, so you want to go over here, puts. So we're going to buy a 200 put, or no, sorry, 220 put, $14.80. That's a pretty expensive put. And let me just do this as a single. If we just do a single, okay, and I just hit confirm and send, that's going to cost me $14,000. All right. But if I did a vertical, buy 220 down to 200s, so plus 220s minus 200s, that's your $20 spread, confirm and spend, that's going to only cost me $8,400. All right, and I'm doing 10 lots here. I mean, you're risking 84 to make $11,000, okay? I mean, Tesla's a big price stock, and I'm doing something very wide. Okay, this is a very wide spread. A $20 spread is extremely wide. You probably wouldn't do something that aggressive. I'm just making an illustration. I mean, I would even do something like, if you think it's going to go down, maybe do like 215, 200. Even a $15 spread is quite wide. Just illustrating the point that it goes from, it's about half the cost. So I went down to 2 lots, risking 1,600 to make 2,300. Okay, on that put. And I haven't even spoken about probabilities. Okay, great question about stops. Okay, here's the other good thing about Elliott is we know exactly where we're wrong. Okay, generally in second waves, that's why this is color-coded orange, and all the charts that we put up for clients have these color-coded levels in there. If we get above 237, the trade is not working, and we need to either defend it or get out. Okay, so if we get above 238, the trade is wrong. Okay, I wouldn't probably risk all the way up there at this point. I mean, if I was selling Tesla up here, I'd use that as a stop. But being that we've seen such a strong move lower, I would just put it above this high. If we get above 230, I'd probably get out. Okay, so yeah, stops are defined by Elliott, and we tell you exactly what those stop losses are. Okay. So that's that. So those are verticals, and I'm definitely pushing time here, and I'm gonna just keep kind of pushing through and just give you guys some more examples. All right. So long call, that's your debit. Long call debit. Basically, you're buying a pullback, a three-way pullback, and you're looking for your upside objective. So you buy an option at the money in the money, and you sell your upside objectives. All right. I'm gonna save this for another time. Now, let's go the other side. Credit spreads. All right. Credit spreads are different. This is where you can really start taking advantage of the volatility aspect. High volatility, high probability of being correct. All right. This is a little bit more tricky and this is a little bit more advanced, but I'm going to show you what this means. Now, if you are bullish, you would do what they call a put credit spread. That involves selling an at the money put for X. All right, so let's think about that. And I want to bring over this platform. Let me just log into this. I'm just going to start showing you some probabilities and just show you what I'm talking about. Okay. Trade. All right. So let's take a look at Google. Hopefully they'll give us quotes here. Actually, no, we're working Facebook, so let's work Facebook. And if you guys have any stocks you want me to look at, let me know. Okay, so let's take a look at selling a put in Facebook. I'm just going to set up this put credit spread. I'm going to take it one leg at a time. So rather than buying along a vertical here, buying a debit spread, buying an at the money call, selling an out of the money call, let's sell something a little bit lower. Now, one of the rules of Elliott is wave 4 cannot go into the territory of wave 1. And when you label it that way, our software gives you an error message, no good. So that's a great place to begin looking to sell options, especially in high volatility areas. Okay, once the market is getting into a high vol range, high extrinsic value, that's when you want to be focusing on selling options. And that's a big part of what we do in the options service. So if I know that, okay, wave 4 should not move into the territory of wave 1 and the wave 1 high is right at $65, let's see what would happen if I just went over here, option. I'm going to short a put, which if you're long a put, you're bearish. If you're short a put, you're bullish. Go. We're going to do this. Let's just say we'll do it with 3 days to go. So that's a little risky, but, oh, sorry. This is Google, Facebook. Choose strategy, option. We're going to go short put and go. Okay, perfect. I said I want to sell the wave 1 high. Let me just put that label right there. 65. So let's sell the $65 put. Choose strategy. So we're going to scroll over here. And we can just slide the guy over 65.5, 65. Perfect. Okay, now here's where we start getting into probabilities. With 3 days to go, you can sell a 65 put when the market opens. You'll receive 18 cents for it. So per contract, okay, I have one contract loaded. You can make $18. All right. Now this loss is massive because this is an unprotected short option. All right. That is basically if the stock, if we go bankrupt, that's how much you're going to lose. It's not really going to happen. Shorting a put is really the same thing as holding the stock. All right. So you can make $18 per lot. And you can do that with a 78% chance of success. That's according to the options model. All right. And here's that dotted line. Here's the bell curve. Here's the 68%. Okay, this is giving you a 78% chance of success because this 68% is really only from here to the middle of the curve. You got to get out and you have all of this right here to be right. If the stock is anywhere from here over, you're right. And that's a 78% chance of being right. So that's when you start trading with high degrees of success. And that's how you can consistently start to make some money. We take it a step further by doing Elliott. we have a better than 50 chance of being right in the market call by doing Elliott Wave. So I think this number is actually higher. Okay, so you could collect a quick, if you were just to do 10, flip it up to 10 lots, review and send, and you can make $180. And as long as the stock, is less than or equal to $64.82, which is right here, you will collect that full premium. If the stock starts to move down, you're obviously going to close the position. You're not going to be susceptible to the whole loss. I mean, this is if basically Facebook goes bankrupt in 3 days. So don't let that scare you away. But this is how you trade with a high degree of success. And this number would actually be greater if the implied volatility was a little higher in Facebook. It's not. Okay. Google, this has a rank of 50, which is this proprietary index over on Thinkorswim, which I really like. Okay. If you are selling a put that's one standard deviation, you can have an 81% chance of success, receive $2.30 on a Google trade, and have, again, an 81% chance of success. Now, I know those unlimited losses are starting to creep you out. So here's what you do. If you want to get bullish on a stock, you sell an at-the-money put. Okay, so let's say the market's going down. This is 60. Let's say you want to sell $58 put. If you sell, you will receive, so you will get, let's say it's $5 in your account. Okay, the way you cap your risk is by doing a spread. You go a little bit lower, and then you buy a $56 put. The stock is at 60. And remember, puts get, as you get further away, okay, puts are going to get cheaper and cheaper and cheaper. I mean, the $40 put, it's probably going to be trading for like a penny, right? It's going to be very cheap because it's so far away from current market. So as you go lower, the price of these puts is going to get cheaper. So if you sell the 58 puts and get $5 and then buy the 56 puts, you're going to have to pay, let's say, $3 minus 3 out of your account. Okay, plus 5 minus 3 equals plus $2. That money goes in your pocket right now. And all you need the stock to do is to hold your support level, then begin to move higher. Okay, and then you collect the full $2 in your pocket. If the stock does not work and we go from $58, the trade does not work out, it goes down to 56. By being long a put, that caps your risk. You have no more risk below this level. So your max risk is the difference between 58 and 56. Okay, the time to do that is when the volatility is high in options. Okay, a very quick way to look at that is when you just go to the implied volatility chart and say, all right, it's kind of in the top end of the range. If, the implied vol for Google here is like 0.14 to 0.40, okay, so got about what, 25, so add 12 on top of that. So, I mean, it's really right around 28. Let's say it's above 28, 29, 30, above the top end of the range. That's telling you that the money you can make is worth it in high volatility markets because, again, the options that you're selling at the money puts, okay, in high volatility environments. Remember, the extrinsic value is going to be high in high vol markets. So when IV, implied volatility, is high, you'd want to be looking to do this because then you can get a decent amount by selling at the money puts or selling at the money calls. All right, so that's really what we're looking to do. Okay, so from here, let's look at some credit spreads. We have a trade actually ongoing right now in Yelp. We put the trade on. We actually just got filled today. So let me just bring over that trade. Position. No, I don't want order entry. Delete. Okay. Trade. Okay. So let me first show you the chart in Yelp. And this stock has been very weak. Stocks. Yelp, right there. Down 3% today. Kind of got wrecked. Okay. So we see Yelp moving lower, and we have a position in Yelp. We think Yelp was going to hold this resistance around 73 and then begin to move lower around 60, right? So we did a couple things. We said, all right, how do we trade Yelp? Let's go to Yelp and look at implied volatility. It's very high. Okay, it's really moving up towards the upper end of the range. And there's this little trick up here, implied volatility percent. It tells you, and I know it's pretty dark over there, but it's 57%. Okay, so that is, obviously it's a scale from 0 to 100, so it's above 50. And you can tell the implied volatility is on the rise. So this is a time where you want to be focusing on credit spreads. So we actually did this in two ways, all right? We did two credit spreads on this. Okay, in Yelp, on the top side, we sold the $75 calls. Okay, we sold 75s, we bought 76s in July. Now, why would we do that? Why would we buy 70? Why would we basically get short Yelp into 75? The 75 level is right here. We do not think that this B wave is going to get above the 50% retracement. And it certainly shouldn't get above the 618. So over here, you're going to notice that the 75 level is right at the 50% retracement, and the 618 is right up here around the 76. So the first trade was to be like, all right, we're going to sell the 75 call, which is right at the 50% retracement. We're going to cap our risk by buying a cheaper call, which is higher at 76. So for that, what did we do? Price. We sold 10s. I'm not going to go through the prices now in the interest of time, but we sold 75s, bought 76s. We received a credit there. Okay. On the downside, we also did a credit spread in the puts. We minus 10, we sold 66 puts and bought 65s. Why would we be short 66 puts if we're bearish on the stock? Okay, because we think that the objective for this trade, remember, this only has 3 days to go. This is for expiration in July, which is on Friday. We do think we're going to head lower, but we think it's going to be into next week by the time we get down to the lower end of this range. So provided we stay above 65 right here and below 75, we will make the full amount in the trade. Okay, the trade was up today. It was up $225. Okay, and each day that ticks away, we are going to receive this kind of time decay that we're talking. We're going to receive the extrinsic value because we are net short options. We're short 66 puts, short 75s, but we have the 76 calls and 65 puts as protection. So basically what we're doing is we just did two credit spreads. Sold 76 calls, so on and so forth. Okay. Now, that is an iron condor. Exactly right, Harry. Yep. Exactly right. So that is basically the whole point. And I know some of you are just new. All we're trying to do, guys, is the higher the implied volatility, right around that 50% mark, we want to focus on the credit spread part of it. Okay. Google is another one that has high implied volatility, but let's look at Apple. Apple is on a tear right now. Okay. I'm gonna fix that setting. I hate that setting. Actually, I don't know how to change that in TOS. If anybody knows, let me know. Oh, that's terrible. Okay. So implied vol is actually very high in Apple, 57%. It's up around the top end of the range, looking pretty good. Okay. So if you wanted to buy a pullback in Apple, you would say, all right, let's say I think we're going to hold below, I think we're going to hold the $94 level and move higher. Or maybe even the 786 at 94. All right. So with a high implied volatility, we think the stock is going to do this. Drawing line, we're going to go down in here, and then we're going to move up. Okay. So then what you can say is, all right, a good way to take advantage of this, I don't like buying the 94 call and then selling something higher because implied volatility is a little high. The risk reward isn't going to be that good on the trade. A better way to do it would be to sell options below it. And the way you would do it is sell a put here around 94 and then buy a put down here, which caps your risk. If you sell 94s, you're going to get a higher amount than what you're going to have to pay down here at 93. So you're going to collect money. So if we go back over to the platform, Apple, choose strategy. Oh, don't freeze up on me, baby. Okay. Loading, choose strategy. And what you're going to do is vertical. And this is called a short put vertical. And we'll do it with 3 days to go. You know, not a lot of time. We think the stock should stay above 94.23, so we can sell the 94 puts. So puts are down here, and you just slide it till you see 94, and of course it has these weird strikes. 94, so we're going to sell the 94, and then we can buy, oh, it's got these weird strikes, 92.86, that's fine. And what's interesting is, okay, if you go out to your standard deviations, here's your first dotted line, 68%. So by putting this trade on, we are outside of one standard deviation because all that's saying, guys, is over the next 3 days, the life of this option, there's actually an 84% chance that the stock is above $94.50 based on the option pricing. So if you are selling options down here, you need the stock to stay above this level above this level, 93.83, and you can collect this full credit. And you have an 87% chance of success. Okay, so you can collect that money, and that's basically just like picking up free. It's essentially, if you have an 87% chance of success as the options market price it, but then you do your technical analysis on top of it, I think that the probability of success goes up. All right, so that is the credit spreads for Apple. Okay, that's that. All right, so let's get going. I know you guys probably have a ton of questions and stuff like that. So another great time to sell credit spreads is into a wave 5 position. Okay, wave 5 with a lot of fib resistance up here. If you find, and this is what we do a lot at Trading Analysis, the combination of fib price and time will tell you when this move should reverse. You can then begin really honing in and saying, all right, we've seen a good 5-wave move up. I'm going to look to sell a call credit spread, which would be sell options above. And of course, you'd like to see it with high implied volatility up here. Gold is a good example of one we looked at. We're looking at resistance in gold. Volatility has been on the rise in gold, but you know, into a wave 5 move, love selling love selling calls above and then buy an even further call to cap your risk. So the most important thing is, guys, spreads, with spreads, you always have capped risk. You also have capped reward. In high vol environments, you want to do selling credit spreads. In low vol environments, you would like to be buying debit spreads. Okay, credit spreads have a high probability of success, but the risk reward ratio is not ideal. Okay, with the higher probability of success, risk reward is going to suffer. Debit spreads generally should be at a 50% chance of success of being correct, and your risk reward is generally about 2 parts reward to 1 part risk. Sometimes it's 1.5 to 1, and even sometimes it's 1 to 1. So those are debits and those are credits up here. The good news is, guys, with the platforms that we're trading, I mean, it couldn't be any easier to trade these. If you want to do an Apple, all you got to know is, all right, if I want to do a long call vertical, which is your debit spread, long call, you just go, it lines it up for you. The green is the buy, the red is the sell. So if you want to buy the 97.86 and sell this, you can kind of slide them around. Let's just say you want to do a 97.98 call. It's going to cost you 16 cents. You have a 42% chance of success. I have $16 of risk with $170 of potential profit, right? So even if you don't quite understand the strategies yet, that's what the platforms have become really advanced, where they can lay it out for you. Yeah, Brad, I'll talk about Yelp, but let me just William, just let me get through it. William, definitely outside where this is such a basic options class, and it wasn't. I mean, a lot of people are new in options. Trust me, guys, if you are a little confused, I understand, and it's my mission to understand, to help you understand what to do with these options. But again, I mean, it's something that we can teach, we can learn. The option trading market has just exploded. I love how it ties in with Elliot Wave. It's unbelievable. The trades that we're picking out. I mean, I love it. It's so fun. I mean, I love spot. I've always traded spot market, but options are a blast. So if you're confused, don't worry. We have a lot more teaching to go. This is just kind of showing the overview. Yep, that was an iron condor on Yelp. Yeah, Dean. So the website, we do recommend a couple platforms. You can get information. Just go to tradinganalysis.com, and if you go over to recommended platforms, I think we have it. Preferred broker right there. That was the Thinkorswim platform. Both of these were Thinkorswim. So this one is Thinkorswim, and this one is called Doe. It's an overlay to Thinkorswim. So if you have one account, you can trade both. So no problem there. And the platforms are all free, which is great. Okay, so that's that. So we did Facebook, Yelp, and Google Live Analysis. I jumped ahead, so no problem. So guys, if you would like to get involved, we did just launch an option service, so you can just head over to tradinganalysis.com. The trial is now open. We've just actually put up the trial for stocks, options, and ETF. Okay, so if you just go to tradinganalysis.com, join today, and stocks and options right there, learn more. Jump in there. We have a description of all the aspects of what we have to offer. You get a $30 30-day trial for $7, and you can get everything that we've shown you here. We have, let me just give you a spin around the members area and then I'll get to questions. In the members area, we have the stock trade desk, which shows you all of our open positions, setup charts, our convictions, details on all the trades, all of our closed trades, previous months. That's the trade desk. You go to the chart room. It's got all of the analysis that we do. We have scrolling commentary throughout the day and night. We have all of the Elliott Wave analysis on the major markets that we're looking at, S&P, the NASDAQ. We scroll charts throughout the day to show you exactly what we're looking at. Google 30-minute right there. You can pop the charts out. We do email out and text message out all trade alerts. And finally, we have the morning strategies of the day video. So you get everything with your membership. Video is basically what I'm doing here, taking you through the analysis, taking you through the charts, the futures, explaining what is going on in the markets and showing you the strategies.
Again, I'm going to remain open-minded
explaining Elliot Wave
now.
to you, explaining what we're doing. So it's a pretty comprehensive offering. So you can get all that for just 30 days for only $7. Sign up right there. Okay, so that is what we're doing. You can contact the crazy ladies of trading analysis, Rosa, who I think is on the call, Lauren, who's flying through the woods, and Rosa is drinking at a concert, which is typical. So that's our information right there, guys. So I know we have a lot of members on the line here, but obviously there's going to be a lot more people diving in with the new option service. So, Marshall, Dave is having a live concert. I'm just going to answer questions right now. So if you want to go listen, he says Dave Matthews is having a live concert right now. I don't want to keep you from that. Actually, I have some good Dave Matthews concert pictures. Let me see if I can find them real quick. Google Plus. Rosa just texted me, why do I have to be the drunk? You're not. I'm saying you have a big smile on your face. But that big drink is gone, so that's pretty funny. Let me see if I can find these pictures. Google Plus. And then guys, go ahead and let me know what the questions are. I know there's a lot, and trust me, there's no question too basic. I certainly understand that there's a lot to it. And while you're typing in that, I'm going to look for my Dave Matthews concerts, just for you, Marshall. That's actually the, Rosa's going to laugh, but that's actually the concert we were at when Rosa had that picture. That was Kenny Chesney right there. We had decent seats for that one. Let me just see if I can find the Dave Matthews. And then I promise I'll get back on track here. Oh, there's Dave Matthews right there. Marshall, if you're still there, that is Dave right there. We had very close seats for Dave. He puts on such a good concert. I remember seeing him in high school, and he is just as good, man. So, okay. Such a great show. Greg, yes. Wave Trader always works. Wave Trader signals triggers us into trades. The only time it doesn't work, and one of the big factors with range strategies, which we didn't touch on, which would be great. Let's say Yelp does this. Okay, let's say Yelp is going to go into a triangle. We want to trade that. Okay, if we want to go like this, let's say we need a 5-leg triangle in that. So we get 3 up, 3 down, which could very well be. We could go into a triangle. Once you have 3 up, 3 down in a correction, you know that's either a flat or a triangle. Here's where you want to start doing range-bound strategies. And you just want, basically, you want the market to go sideways. You want it to stay within this range. So there is no wave trader signal that you're going to look for. Okay, if you're doing a strategy like here, where you're looking for a pullback into a fib zone, then get a trigger, you want to then use Wave Trader to do that, and that's going to be a debit spread. okay? And you want to look for a signal. If Yelp is high vol like it is, you could buy a debit spread by going, okay, let's plus 66 calls minus whatever 75 calls, which sell 75. That's the debit spread. Or you could do it below. You know, you could do a put. Oh, that's a terrible P. Put credit spread. You could sell 60 puts, buy 58 puts, all based on a signal inside of the zone. Okay, so you could use Wave Trader with either one, and this is Wave Trader is a plugin that we have that triggers us into trades. But again, we didn't touch on it, but range bound strategies, which is very important with option trading, wouldn't get a signal. So I hope that makes sense. Al, the offer again, all you guys have to do for the site is just go to tradinganalysis.com. And we're going to have a lot. This is actually our first options webinar. So tradinganalysis.com, we're going to have a lot more to go because, again, I have a lot of customers who, you know, they've been with me for years trading other markets, trading FX markets, and just more opportunities over here for now. So I have a lot of education to go with our newer guys who are newer to options. So so again, come on over and check us out. But again, if you're kind of up to date on options, I mean, you can tell we're doing some of the most advanced strategies already. We're doing iron condors and stuff like that. So we're going to confuse our existing guys, but don't worry, we're gonna get you up to speed, promise. So tradinganalysis.com, and you can do a 30-day trial for $7, and that's that. Okay, let me see here. Questions? Yes, Edward, updating Motive Wave, agreed on it, and that is a promise. And yes, this is being recorded. FAS, don't really track that one. Let me take a look. FAS. I'm gonna have to do this. I'm gonna have to add an instrument because I'm sure I don't have it defined. Copy. Oh no. Okay. Oh, it's an ETF. Interesting. What is it? Let me add it in my ETF column. Directional daily bull. Oh, financial bulls. Oh, interesting. Okay. Here's the thing with leverage ETFs. Okay. And I don't want to get too off topic, but don't trade them with options. Okay. Don't. Here's the reason. You don't want to use these leverage ETFs on options. You might think, oh, I'm going to get a ton of bang for my buck. No. You're going to pay more in commissions. Okay. Let's say the implied volatility is, let's say 30% on the financial ETF. Okay. The implied vol on a 3x will be a third, will be less. Okay, so what it's going to make you do is actually trade 3 times the amount of shares to get the same impact, and your commission is going to be 3 times higher. So don't trade the leveraged, okay? Trade a more expensive stock, trade a higher expensive, more expensive, and you can trade fewer shares, okay? So trust me, it's not worth it to do options on the leverage. I hope that makes sense. But in terms of the chart, oh, that's kind of interesting. Looks like it's kind of breaking out in wave 4. Or wave 4 is complete. 1 would be A, B, C, 1A, B, C. So that's 2. 1, 2, 3, 4, 5, 3. That looks like 4, 5. Always want to be able to make sure you can count 5 waves in wave 3. 1, 2, 3, 4, 5. This is just a quick look. Yeah, 1 ABC, 3, 4. 1, 2, 3, 4, 5, 3, 4. Yeah, I mean, just a really quick look. Ratio analysis 5 and 1. Pin it. I'm just hotkeying my wave 5 objectives. Pin it. Alt 5. You're just basically looking for the green levels. So little, maybe like a 110 target, and then I want to look at this price swing compared to this price swing. Degree increase. I want to do distance traveled in A compared to distance traveled in C, ratio analysis C and A. Oh, equality is right there. That's kind of interesting. And then let's do a time analysis. We didn't do anything about time, but time elapsed in A versus time elapsed in C. Oh, interesting. Yeah, if I'd be shocked to see it break above 111 prior to August 6th. So we have a 200% time measurement right here on July 17th and another one on August 6th and fib resistance into 112. So that's kind of interesting. I'll keep an eye on that. I'd rather have you just look at the XLF, which is the financials ETF. Okay. All right. Let's go. $7 offer. Yep. Al, I hope I answered that for you for the $7 offer. Just a free trial to tradinganalysis.com right there. And join. Marshall, good. You've been hard on the leverage. Thanks for the tip. Excellent. 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 Good, good. Hey, thanks, Paul. Appreciate that. Software we use is Motive Wave. We also have it on our site. It's third party. It's awesome for Elliot. We're actually building, actually going to start working with the owner and an options Elliot Wave plugin. So that is on the drawing table. We're a long ways away, but if you want to find out more information about Motive Wave, just go over here to Trading Tools, and Motive Wave is right there. And we have training for that as well. Okay. Features. I'm assuming you meant futures. Al, sorry. I hope I didn't make it hard for you. Tradinganalysis.com. Yeah. If the question is, do I trade futures? Yes, but I don't. I just don't. I used to trade futures all the time. Commissions are so bad if you're scalping. There's no way you make money scalping futures. It doesn't happen with the way they're set up, with the size of the contract, with how often you have to trade. The commissions will kill you. You have to make like, one of my buddies figured it out. Like if you're trading, I don't know, whatever, 5-6 times a day, you have to make like an 80% return at the end of the year on your account to even break even when commissions are tied in. So we like to be swing traders. We like to hold trades for 2, 3, 4 days, maybe 2 weeks, 3 weeks in most of our options positions. So we like to keep those commissions down and trade options when there's a good Elliott Wave setup. So hope that makes sense there. Hey, Paul, thanks for the nice words. Motive Wave, yes, Derek, absolutely. Love Motive Wave. You don't have to do it. I mean, you guys saw me using the Thinkorswim charts. I mean, they're great. It's an awesome platform. I mean, I also use TradeStation. Don't have it up, but yeah, that's that. Okay. Any other questions, comments? If not, I'm going to go hang out with the wife. That's pretty funny. Weeklies, Bubba. Yep, love selling weeklies. Theta is the time decay, the extrinsic value in the weeklies is much higher, so I love selling weekly options. Don't like buying weeklies because you don't have much time to be right. So let's just take a look to kind of drive that point home. So here's the chain in here's the chain. So the blacks are the monthlies and the reds are the weeklies, as it says weekly right there. So all right, let's just do 6, and then let's do 6. Okay, so let me change this to theta. Okay, so theta is that time component. That's how much you lose by holding the option. Black is the monthlies, and I know they're a week apart, so it's probably not going to be a great example. I wish I had something closer in terms of that's okay. So let's just take a look. So 595s calls. Okay, you're gonna lose. That's actually not even a good example. Let's try it over here. Let's try the 24 weeklies and then these monthlies. So I mean, there's the weeklies expire 7 days prior, but if you look at the 595s, the theta, you're gonna lose 33 cents a day on this. Okay, and on the monthlies at the 595, you're going to lose 27 cents. So, that's a pretty big gap, and these are, nearby options. So, point is, theta is the time extrinsic value part is much richer in weeklies because you don't have a lot of time, right? So, I love selling premium on high applied volatility for weeklies, and we do those with credit spreads. Counter spreads, we talked about that one. And stops, yep. Okay, good guys. Rick, awesome presentation, Todd. Thanks. Played simple, wait for presentation, very complex. Thanks, Rick. But again, we hit some difficult areas. So if you've understood half of what I said, I'd say well done you. We definitely hit some difficult stuff, but I just want you guys to understand why we really like to focus on the volatility aspect, and then we can plug in the specifics. And in the trade desk, we tell you exactly what to do with the trades. So for example, Yelp. This is a trade we put on today. You got to buy 76 call in July, sell the 75. Sell the 66 put, buy the 65. Total credit received should be 33 cents. So, we can show you how to set that up. And, it's even cooler, these new options platforms. Again, those of you who are familiar with that strategy, if you wanted to just do an iron condor, that's what it is. You just click iron condor, normal, you hit go, and it kind of loads it up for you. So it's actually an Apple, it's loaded up the one standard deviation. You're selling the 92 puts, selling the 99 calls, and you're capping your risk by buying the 101 calls and buying 92. So this is a credit spread. That's a credit spread. It's just loaded it for you, and you can slide these things around to whatever strikes you want. And you'll see the probabilities change, and you just hit review and send. You're risking $59, or you can make 59, risking 227. Of course, you're never going to let it go to max. You're never going to let it go to max loss, so that's not even relevant. But basically, you have a 73% chance of collecting $59. So pretty sweet. And then, of course, you do the wave count in there. All right. So that's going to be it, guys. I'm going to finish it up. Way too long in this webinar, but we got through the content. So I will talk to you guys soon. Have a great night.